while, for those who've just joined us, we're going to wait just another 2 minutes or so, and then we'll jump in. All right, we're 12:04. I think this is a great time for us to get started. So thanks everyone for joining us for what is now the second installment in a new series that we are organizing at the Jane Family Institute called our Expert Hour series. And the idea is to be joining an expert in conversation about themes relevant to our different portfolio areas at JFI. And today we are extraordinarily lucky to be joined by Elizabeth Harnett from the Rocky Mountain Institute. I'll tell you a bit more about Elizabeth and about RMI in just a second. But here at the top, just to introduce our conversation today, I'll note that the Jane Family Institute, for those not familiar with it, is a small applied research organization based in New York City, working basically at the intersection of finance and social provisioning, with an increasing transversal focus on the energy transition and questions of development. My name is Paul Katz, and I lead our social wealth portfolio, which is focused on supporting public asset owners to drive forward a green and just transition. And we have a number of projects. Just to mention very briefly, we've been working together now with a number of subnational governments in Brazil to develop permanent royalty funds from oil and mining royalties. This has been an ongoing collaboration with the local university for about 5 years now, working with the V20 Climate Vulnerable Forum, a group of particularly climate vulnerable countries, to develop a proposal for a multi-sovereign investment fund across this multilateral organization. And we've been partnering with the International Forum of Sovereign Wealth Funds to organize a conversation among public asset owners concerning social impact measurement and monitoring. We see all of these as kind of pieces of a broader puzzle to ensure that public assets are being leveraged in service of a green and just transition. So today, our topic couldn't be more relevant to this work. It's Transition Finance 101, and the person who's going to be taking us into this really fascinating and extremely promising world is Elizabeth Harnett from the Rocky Mountain Institute. First, I should say that the Rocky Mountain Institute is an independent, nonprofit, nonpartisan organization founded in 1982 that is now active in more than 60 countries globally. Its goal is to transform global energy systems through market-driven solutions to secure a prosperous, resilient, clean energy future for all. In collaboration with businesses, policymakers, funders, communities, and other partners, RMI drives investment to scale clean energy solutions, reduce energy waste, and boost access to affordable clean energy in ways that enhance security, strengthen the economy, and improve people's lives. And joining us from RMI is Elizabeth Harnett, who of course you see on the screen. Elizabeth is a research and impact expert with RMI's Center for Climate Aligned Finance. Her work includes the design and execution of novel research and thought leadership aimed at helping financial institutions to align their investment and lending decisions with the goals of the Paris Agreement and the net zero transition. Prior to joining RMI, she worked as a lead researcher at the Oxford Sustainable Finance Program within the Smith School of Enterprise and the Environment at the University of Oxford. In this role, she contributed to both academic research and teaching on sustainable finance. She also spent 2 years seconded part-time from Oxford to the Secretariat of the One Planet Sovereign Wealth Fund and One Planet Asset Managers initiatives. As a technical advisor to these groups, she supported 34 financial institutions with 30 trillion in assets under management to better integrate climate-related risks and opportunities into their investment decision-making. So as I'm sure you can gather from this bio, we're going to have a lot to talk about. And our plan is just for me to pose some questions for the next 30 minutes or so, and then to turn to questions from others here in the webinar. So if you look at the bottom of your screen, you'll see that there is a Q&A button. You can click on that Q&A button and type your questions directly there. Please feel free, if you wish, to identify yourself in text along with your question, but also feel no obligation to. You can ask the questions anonymously as well. And then, as our conversation advances, we'll be threading some of these questions into the discussion. So please do feel not simply invited, but enthusiastically encouraged to share your questions in that Q&A box. But I think with all of that said, let's jump right into our discussion for today. And I'd like to ask here at the outset sort of the foundational question for today, which is, what is transition finance? How would you define that phrase, Lizzie? And what makes transition finance distinct from climate finance?
Yeah, thank you so much, Paul. And hi, everyone. Really nice to be here with you for this next hour and talking through the topic of transition finance. So, the easy answer to your question is that there's no answer to your question. There's no one kind of strict definition of transition finance. And actually, it's a running joke within our team that even though we're experts on transition finance, we don't really know what it is. But there are more than 20 different definitions kind of floating around in the research and the guidance on transition finance. And so we've done a lot of work trying to distill what are some of the kind of main debates in transition finance and how do we kind of navigate a path forward without coming down on one side or the other, because ultimately what we think is the most important thing when we're talking about transition finance is that we get finance flowing to the transition. And that's the transition to net zero. And so broadly, you can think about transition finance as any type of finance or investment that promotes kind of economy-wide transition to net zero. We call that big T transition because that's the kind of whole big picture of what's transition finance. But we also like to think about little t transition, which is much more focused on how does the finance community support the transition of companies? And so that is taking high emitting companies and making them lower emitting and supporting transition plans that companies might have set. And so that's kind of one of the main kind of, I would say, debates on transition finance, whether it's big T, whole economy transition, or little t, just supporting the transition of companies, both of which matter and aren't, mutually exclusive. If we have a lot of companies transitioning to lower carbon, then we can get to economy-wide transition. But so the focus doesn't really matter, but it depends kind of what your goals are as an institution, what your goals are as you go. There's also the kind of conversation as to whether transition finance should only flow to high emitting sectors, or whether it can be a broader conversation as to who can access transition finance. And this becomes really important only when you're talking about labeling of a transition finance product, like a transition bond or a transition fund. But generally at RMI, we think that transition finance should be flowing mostly to high emitting sectors because that's where the additional funding is needed. There's a lot of climate finance funding and green finance funding available for this climate solutions, like the low carbon, renewable energies, energy efficiency, that kind of thing. But actually, getting money into the hard stuff is actually really important. You're thinking about how do we decarbonize steel? How do we decarbonize cement? Those kind of things. Actually, it's much harder if you're an impact investor or you just want to invest in green to put money there. And so actually that's a section of the economy we think needs more attention, and that's where we think there's a lot of opportunity for the transition label to really play a role. So as I say, there's no one perfect definition, but there's lots of different pieces. In at COP28, we put out a global call to action on transition finance, and that kind of gave our four kind of elements of transition finance that we think are going to be really important going forward. And that was co-signed by 11 other NGOs in this space. And so that kind of is maybe our best answer to what transition finance that is. And that focused on decarbonizing high emitting sectors. So did specify that. It also focused on supporting companies with a credible strategy to get to net zero. We don't want to just be giving money to anyone at this point. It focused on how can you monitor that progress in transition, again, so that we can prove some credibility. And how do you avoid carbon lock-in? So making sure that if we're supporting high carbon sectors, it's not just going to prolong the lifetime of high emitting assets. So those are kind of some of the guardrails I'd say that are really important when we're defining this topic.
Wow, what a really rich answer, and I feel like actually there are so many threads that I would love to pull on a little bit. I will just say, I mean, the distinction between sort of the big T and the small T transition, I thought was extremely generative, and it has me thinking. Uh, the way that you framed it was kind of one in which finance is cast into a supporting role, right? Especially with the little t. How do financial flows support the transitions of companies? And I think that's a really kind of maybe sounds obvious, but an important perspective to bring because sometimes I feel like in these conversations, actually, the role and kind of the needs of finance end up getting really centered. And sometimes it seems actually that the needs of the participants in the real economy, who are actually the ones who are going to be making an material impact, are almost sort of made secondary. So I wanted to ask, I mean, we all know how important the energy transition is to the sustainable future of industrial civilization. But I think it may be less obvious to some people, especially people outside of the world of finance, why finance is so central to how people are talking about the energy transition. After all, I mean, this is a transition that has chemical and geological and climatic and economic and socio-political layers, and it involves logistics and regulation and political organization, so much else. But sometimes, especially at like climate-centric events, it can sound like it's just the finance people who are kind of offering the broad views, who are laying out the objectives, who are setting the agenda, and it can make it sound like actually the energy transition is first and foremost a question of financing. So I just want to ask, I mean, that's a really long preamble for this question. Why is it that finance is so central to the energy transition, and has its centrality perhaps been overstated?
Yeah, it's a great question. So I think the main thing to think about here is, I mean, there's this famous quote, money makes the world go round, right? And that's kind of true. And it's kind of true when it comes to the low carbon economy as well. We're not talking about kind of bits of money that can support some more solar panels or kind of seawalls and that kind of thing. What we're talking about is like a complete rewiring and rethinking of how the global economy works if we genuinely want to get to net zero by 2050, and certainly the progress that's needed by 2030 in terms of halving emissions. That's going to require a really big rethink about how we do life and how we do energy systems and how we do the economy. And if we want clean infrastructure, if we want electrified logistics, if we want decarbonized heavy industry, we're going to need money to get that going. A lot of the companies that are going to be at the forefront of this transition, you know, many of them are incumbents in the economy and have kind of fairly strong balance sheets, but they need more support to do those transition plans that they're setting up. And we also need more funding for kind of new technologies and new solutions. So there is a big need and there is a big role for finance, but you're totally right that it's not only finance's problem to solve. And when we're thinking about what role it should play, we really need to balance that with what role it can play, because there's no point in asking a financial institution like a bank or an insurer or an investment company to just solve climate change, because that's not their mandate and they can't do it. They certainly can't do it alone. So we also need to think about how do they play their role within a broader system, and how do we also make sure that other parts of the economy and society are also playing their own role. And that's particularly important for the policy realm, because a lot of what we're hearing, and I think we'll get into this later as well, that from the banks we work with at RMI, is that one of the main barriers to transition finance is actually the policy incentives, and the economics don't work yet for investing in the really hard transition stuff. And so that's where we need policymakers to create those incentives, help the companies, help the entrepreneurs come up with the climate solutions and make it bankable. And by bankable, I mean that it makes economic sense for a bank to be putting their money in. The risk and return profiles are correct. And so I'd say it is a kind of a whole system is needed to make this happen, but it's already starting. I mean, the risk return profiles are getting better. We are seeing finance flowing, and that's just because the transition now makes economic sense in many parts of the sectors and the regions that we need to transition. So yeah, it's a big part of the solution, but can't be the only part. And at RMI, we're really trying to bring different stakeholders together to solve the solution, to find solutions that really help the right actors play the right role at the right time.
I mean, can I ask, I mean, just following up on something you've just mentioned, I mean, does it seem like maybe the needle is moving now and the risk return profiles are becoming more attractive because of, technological advance, because people are now moving almost sort of more collectively and, everyone kind of wants to be in the pack. Very few people want to truly be leading it. I mean, sort of how much do you think is this kind of an objective question? How much is this a sociological question? I'm just curious to hear if you have a thought
Yeah.
there.
So it really depends what part of the system we're talking about. When it comes to the energy system, for example, it's definitely moving in the right direction. I think there was a statistic that last year, 91% of renewable builds were cheaper than the fossil alternatives globally. And so that is just the case that actually investing in renewable energy is cheaper and better for the environment than fossil fuels. So is something that large banks and large financial institutions are pushing. Where we're seeing more, I'd say, technological and kind of economic challenges is in some of the kind of shifts to molecular structures. So the green hydrogen solutions and the sustainable aviation fuel, for example, that's where things like the offtake of those are still a challenge, just from an economic and technology perspective. Certainly the scaling of those technologies. And that's where we need kind of bigger support from policy incentives, bigger coordination between the corporates and the finance sector, I'd say.
No, that makes perfect sense. And I mean, certainly, you mentioned the kind of one set of key actors here, right, are big banks. And I mean, certainly just thinking about the kind of balance sheets of these institutions, getting them to feel that, this is these are sectors that they want to be in is obviously really critical. I mean, are there any banks, either, public, private, or multilateral that in your experience really stand out for getting this right?
Yeah, so we've seen several of the large banks have created kind of net zero targets, and actually several of them have created transition finance frameworks as well. So I think Standard Chartered was one of the earliest movers. I think they put a transition finance framework out in 2021, when this was kind of a very nascent term. More recently, Barclays Bank has put out a really interesting sector by sector framework, in which they kind of outline what they consider to be transition enabling in different kind of key sectors around the world. And theirs is really interesting because they also kind of share how their exposure to those sectors is changing over time. So that's a really nice example. On the public finance side, we saw the Japanese government were the first to launch a transition bond. And so that was, they'd put out a green and transition taxonomy the year before, and they used that taxonomy to kind of shape this use of proceeds bond. And that was for everything from kind of subsidies for green technology and R&D to energy efficient buildings to kind of other green kind of initiatives. That came under some, I'd say, critique because of the breadth of solutions that they were using. But that's always the challenge. There's always someone to critique when it comes to transition, because everyone's coming at this with different definitions, as I mentioned, different expectations as to what carbon lock-in means and over what timeframes we need to transition in different regions and different sectors. So I'd say there's good practice. There's maybe not great practice yet. There's nothing like perfection in the transition finance market, but at RMI we're very pragmatic and we recognize that actually good is better than nothing. And so that's something that we want to encourage, kind of making progress and not just looking for perfection.
No, absolutely. I mean, couldn't agree more. Can I ask, I mean, these good plans that you're seeing, is it primarily about sort of having that benchmark, about bringing more transparency to these questions, or are there kind of actual sort of teeth in these plans? Are there kind of mandates involved, or is it more about the transparency in the documentation?
Yeah, so there's definitely there's a range, as with a lot of these things. There's different approaches that are being taken, I would say. Some are very much target focused, and so some of the frameworks have like a dollar figure that are being attached to. We want to put like 500 billion into the energy transition by 2030, and so that then you need to have some way of saying whether a loan to a company can fit within that target. So it's, I think, more of an accounting and target setting perspective. Others is much more for the transparency if they just want to be able to say, we have 30% of our portfolio that is supporting the energy transition, and over time we want to increase that. Others are just focusing less on the targets and the transparency and just getting deals done. And so that's much more of a case study based approach, I would say. And then I think the main thing we're really seeing is a whole of bank approach that is more of a transition plan. And it is saying our strategy is going to evolve over the next 5-10 years, in which we are going to embed concepts of the energy transition into all of our day-to-day decision making. And that's really exciting. But again, it's very early days, and so it's hard to see kind of what actual impact that's having on the ground. But certainly banks setting transition plans and saying, this is how we're going to change our business model, that's really exciting to me.
No, absolutely. I mean, I suppose this is one of these cases where we'd like to let 1,000 flowers bloom, right? Well, so I mean, we're talking about targets. What are our best estimates right now of current transition financing needs? Sort of how close have we come? And maybe the million-dollar question here, are you optimistic about our ability to ultimately meet these financing needs on the time frame required?
Yeah. So again, there's no good answers, and that will be a running theme throughout the session, I'm sure. The IEA, so the International Energy Agency, estimates that we need about $4 trillion per year by 2030. And that estimate goes up to around $7 trillion a year, excuse me, by 2050. And so it's a lot of money. We also think that around 70% of that needs to come from the private sector because there are more limited public funds available for this kind of investment. But I think one of the key figures to bear in mind when we're talking about the $4 trillion 2030 mark is we're already at $2 trillion. We're already kind of halfway there, which sounds good, but I think one of the challenges is that we've done the easy stuff. And it's the hard stuff that is left, and we only have kind of less than 5 years now until 2030. And so that first half was hard enough, but actually the second half of that 4 trillion is going to be really challenging, I think. Maybe if I can share my screen at this point, I've got a really nice chart that shows kind of where that money needs to go. So let me see if I can pull this up quickly.
Amazing.
Let me see. Can you see that?
Yeah, we've got it.
Okay, great. So this is kind of a brief summary of the financing gap per year that's needed by 2030. And so you can see kind of on the far right, you've got that total of kind of almost over $4 trillion that's needed. And we're around halfway there. We've got just over 2 trillion. But this also breaks it down by sector and by key sector as part of the transition. And so you can see that the energy systems, we're actually doing quite well. We're over halfway to $2 trillion needed in the energy system. Where there are big gaps is actually in the agriculture and the adaptation side. And so this is kind of where we also need to be focusing more attention, because those are pieces of the puzzle that actually historically have been much harder to find those really nice economic win-wins, we say, like good for the climate and good for business. And so that's kind of where we think more attention is going to be needed going forward. But we still have to come back to the energy system is the big chunk of this. We still need an extra kind of 700 billion, 750 billion roughly per year going into the energy sector. And that's where RMI is focused a lot of our attention historically. But I think actually the ties in between the energy and the agriculture and the water systems, this nexus between the food, energy, and water systems that I think are really, really interesting and a nice challenge for finance going forward.
Well, I mean, this chart is amazing, and this is incredibly clarifying. I'm so glad that you brought it to our conversation. Thank you. I mean, I'll say, I mean, just kind of riffing on this and looking at it right now. I mean, I see what comes across in conversations with public asset owners, and specifically with sovereign wealth funds in particular. I see a lot of things that are not especially surprising, right? Energy systems and buildings and infra, being kind of the sort of where you see the kind of least proportional gap. Makes a lot of sense to me. But I guess what is surprising, maybe the most surprising here, is to see that agriculture and water actually is still such a massive gap, given at least what seems to be like the stated interests of a lot of these asset owners. Do you have any insight there as to why this has been so particularly challenging?
It's a great question. I think one of the challenges is just the regional challenge, that actually a lot of the change that is needed in our agricultural systems needs to happen in emerging markets. And actually it's much harder to get funds flowing at scale into those markets. And so I think actually building on where we've both have history of the sovereign wealth space, that's a really interesting space because they have a lot more experience historically of investing in emerging markets and public funds in general. So groups like the IFC, the World Bank, actually there's a lot more to do in the agriculture and water space. And that's actually a really nice way that actually the US could take more of a leadership role because, in the current environment, actually focusing on food security and water security is going to be much more palatable, should we say, than just focusing on climate change for climate change's sake. And so when we can tie this into energy security, food security, water security, I think that's where we can have some really interesting conversations going forward.
No, I love that. And the idea that the interconnectedness of these different sectors could be kind of a hidden strength, I feel like is a really, at least to my mind, optimistic point to make here. That
Yeah,
very hard to
absolutely.
buy.
I think coming back to your question as to whether I'm optimistic, at RMI, we like to say we have applied hope. We know that we can do this. We know that the energy transition is already happening, but we can't just let it happen. We have to work for it. We have to build the partnerships. We have to build the knowledge. We have to build solutions, particularly connecting the dots between different systems, between the agricultural system, between the energy system, between the political and the finance systems. And so there's a lot more to do, should we say, on the financing gap and closing this. But certainly have to kind of hold on to that hope that it can happen. And we're over halfway there, which is great.
I love applied hope. I'm taking this with me. That's the phrase that I'm stealing from today's conversation for sure.
Let me
Well, so
stop sharing.
I mean, another concept that I really loved in our kind of preparation for this conversation was one that I know you've been building out at RMI recently, this idea of the transition finance nexus. And we've already sort of previewed a number of the different nodes in this nexus in our conversation, but I wonder for our interlocutors today. Could you tell us a bit about what the Transition Finance Nexus is and how the concept helps us to meet the challenge of making transition financing flow at scale?
Yeah, let me maybe share screen again. We'll jump in and out of screen sharing for this. But the transition finance nexus, we love a nexus at RMI. The transition finance nexus was a recognition that when we're talking about transition finance, actually over the last kind of 3 or 4 years, there's been this whole ecosystem of terminology around transition that has kind of grown up in the finance space. And so we have 4 different kind of keywords: transition finance, transition pathways, transition planning and transition plans, and transition assessment. And there's a lot of research and a lot of guidance out there on each of those kind of nodes. But actually, what we were seeing is that there wasn't a lot of connectivity between them. And actually, we think that fundamentally, if we want to get transition finance to flow, we need all of these parts of the system to be working together and to be much more aligned. So we came up with this transition finance nexus piece. We put out some research on it earlier this year. That I can maybe share in the chat afterwards as well, or you can find on our website. But it's the idea that actually each of these pieces interlock. So you need transition pathways, which are kind of the scenarios and the ways forward to reach certain transition goals. And that they really allow you to create frameworks around which you can, as a company, plan for that transition. How are you going to help align with it and make it happen? Assessments, it's really important to know where do we want to go if you're going to assess anybody on this, and for financing to know where is the money needed, how does that align with my financing goals, with my exposure within the organization. We also kind of spent a lot of time, and one of the reasons we came up with this concept in the first place was this question around, does having a transition plan automatically allow you to get access to transition finance? And actually, one of the kind of big takeaways from this was no. Actually, there's no direct link in our nexus between a transition plan and getting transition finance. What we have to go through is that assessment piece, because we don't want to just be giving transition finance to any company that has a transition plan without first assessing, is that plan credible? Is it feasible? Is it ambitious enough? Does it actually tie back to credible transition pathways? And so that's kind of where we really wanted to emphasize this transition assessment piece, is if we want to be credible and ambitious with transition finance, we need to know where this finance is going. And so that kind of ties all the way around from having the pathways, having the plans, having the assessment, and also noting that kind of transition plans is one thing, but it can also be transition planning. A company doesn't need a really shiny, glossy transition plan to get access to transition finance and be assessed on their capacity for transition finance. So we wanted to make a couple of those points with this report, and also just emphasize that if we get each node in this nexus better, if we improve pathways, if we improve the quality of planning, if we improve how the assessment process and scale that assessment process up, then we can get more finance flowing. And so that's kind of how we hope all of our work that we're doing on kind of transition finance topics, we're focusing on each of these nodes with the hope that they all kind of are self-building and kind of self-reinforcing to lead to more transition finance flowing.
I mean, can I ask? I mean, I find this to be a really, really helpful kind of mapping of the framework here of the broader concept. I mean, is there sort of a weakest link here, or rather, is my instinct that maybe this transition assessment space is the one that is most nascent? Does that seem right, or is it not fair to talk about a weakest link here?
Yeah, no, I think you are right. I think the transition assessment is certainly where we're spending a lot of our time because it's where we think there's the most opportunity for unlocking transition finance at scale if we can get the assessment right. A bank or another financial institution is not going to give a loan for supporting the transition if they don't know where that loan is going to come from and if they don't know whether that's actually going to be credit worthy, if it's going to be financially feasible. And so, for all the glossy reports in the world, unless a bank can do its own due diligence and know this company is real and really does want to, transition and has a plan to do that, has the capex behind it to do that, they're not going to offer that loan or that financing. And so this transition piece, the assessment piece, is kind of really critical. I'd also point to the pathways as being a potentially weakest link, depending on which sector and which geography you're talking about. Because pathways to be really useful in this assessment piece need to be granular. And at the moment, we have good pathways at a global scale, and we have good pathways in certain sectors, but not on the kind of region specific, sector specific. What is needed to happen to make green steel in Japan work, or power and utilities transition in Southeast Asia, or kind of agriculture in Africa. That level of detail doesn't exist, or doesn't exist in an accessible kind of usable way yet. And so that's another piece of the puzzle that we're also thinking about as it relates to this assessment piece.
Well, fantastic. That is really good to hear, and also it sort of aligns with some of the things that we've got sort of cooking on the stove right now, and are excited to bring to the world pretty soon. Yeah, couldn't agree more about the uh, importance of reinforcing or making deeper and more granular these pathways. So we've got just a couple minutes left in sort of the list of questions that I had wanted to run through, which means that if breaking the fourth wall here virtually, if you're out there with a question in mind, please do sort of piece it together and drop it into the Q&A. We're collecting questions there. We've got three really good ones so far, but please don't hesitate to add your own questions into the mix. But sort of before turning to those questions from the broader group, I did want to ask, about some of the different approaches that financial institutions have been taking, specifically on the implementation side. What of these have been working best so far?
Yeah. So I've mentioned a couple of them through the discussion today so far. The banks are, or the financial institutions, we work primarily with banks, but so that's kind of what I know best in terms of a lot of our think, and I should have said this, a lot of our thinking on transition finance to date has been based on what we called an alignment forum, where we brought together kind of a group of banks over a whole year period and convened monthly on these topics. And through that process, we really got a good deep dive into what the banks are doing. And we identified kind of 6 different approaches that the banks are taking. So guidelines, frameworks, and kind of investment policies were those kind of top down, big picture, how do we think about this topic? But we also saw some bottom up approaches, which were really interesting. So the 3 bottom up approaches we found were kind of building whole taxonomies around transition and around green and transition sometimes. And then you had these assessment tools that we mentioned just before in the Nexus conversation. And so banks are building their own kind of mechanisms, tools, whole internal teams in some cases, to do the transition plan assessment and work out how do we actually allocate transition finance based on transition plans and planning. And then we also found technology focused specializations. And so we found that some banks were saying we are going all in on green hydrogen. We think that is key to unlocking the energy transition. So we're going to build teams of experts on green hydrogen, and we're going to take them out to our different relevant sector desks, whether that be steel or kind of power, etc. And so those are kind of the different ways we've seen it happening. And actually, what we found was the best approaches combine those. So it's not a one size fits all, and it's not a pick one and go for it. Actually, having a set of guidelines or a set of principles that then can give shape to and put guardrails around a taxonomy and a set of assessment tools, that's when you get to a really detailed, kind of sophisticated approach to transition finance. And we put out a how-to guide on designing transition finance. So if you're at an organization that's just starting to think about this, take a look, because we kind of go through some of the pros and cons of each of those approaches and give examples as well. So maybe I can put that link in the chat as well.
Absolutely. And actually, I mean, the kind of reference to RMI's work here leads me to the last question I want to pose for today before we turn to some of these really great questions now accumulating in the Q&A here. So thank you to everyone who's shared a question there. RMI has been such a pioneer in the transition finance space, really from the outset. Can you tell us a bit about some of the Institute's major projects in this area?
Yeah. So I mentioned kind of some of our work on corporate transition assessment, and that's what a big piece of our focus at the moment. A lot of these assessments that are happening, and as I mentioned, teams are building, banks are building whole teams around this and processes internally. But a lot of that is just kind of tick box exercise. Does this company have a transition target? Do they have a plan? Do they have someone in charge of this? It's very kind of formulaic. And what we want to get to is where actually you can take the insights from an assessment at a level that is this plan credible? Is it feasible? Is it actually going to unlock transition? Does it have a business case? Because ultimately we're thinking, this is a business decision. And we want that information to flow into the front office decision making. We want this to inform bank client engagement. We want to inform credit risk decisions. And so what we're calling this transition intelligence. So it's taking the assessment and making this intelligence that can actually drive decisions within the bank. So that's a big chunk of our work right now. We also have some work related to that on pathways, and we're creating a repository of like an online tool where you can assess the credibility and the utility of pathways. And then another report that's actually coming out hopefully next month that I'm really excited about is just like a fundamental recalibration of what is the role of a bank in the energy transition. Because there's been a lot of talk as banks, particularly in the US, but also in Europe, are pulling out of groups like the Net Zero Banking Alliance and kind of rethinking their role in the transition. And we have this new paper coming out saying this is actually a good thing that banks are rethinking their role, because we've actually fallen into a lot of unhelpful patterns in the last few years of climate finance. And that's not just the bank's fault. It's not just policymakers' fault. Part of that is the climate finance kind of NGO community and the advocates expecting things that just aren't in the bank's wheelhouse. And so we kind of go through some of the myths that are being perpetuated. We look at what are the challenges that banks face in actually being productive kind of parts of the energy transition. And then we chart a path forward and say, these are the things they can and should do. And these are the things that actually maybe aren't serving us at the moment, and we need to kind of move on. And so that's been a really fun, really interesting project. And I would love to be able to do that for different types of financial institution. We've started with banks, but you could do a role of finance series in which we say, what is the role of insurance? What is the role of sovereign wealth? What is the role of public finance? I think that would be really interesting as well.
No, I love that idea. And actually, I mean, it brings me to sort of a little addendum to this last question. So many projects currently running at RMI relevant to this, broader mission. Uh, if you suddenly woke up to find your budget tripled tomorrow, what would you do with all of
Nice.
that? What would be your top priorities?
Yeah. So one thing that I'm really, really interested in is how do we make the finance and the policy landscape work together? They're often put at odds, and there's often a lot of blame game saying, oh, it's policymakers, oh, it's finance, oh, it's corporates who need to kind of solve this energy problem. And actually, as I mentioned at the beginning, it's all of them. And so we have this kind of early stage idea that we're calling the capital nexus, where we look at for a specific, technology or a specific energy challenge, who are the stakeholders that need to be involved? And how do we bring them together in kind of a multi-stakeholder forum or convening or series of pieces and actually go, whose responsibility is this? And if it's everybody's, how do we get everyone on the same page? Who needs to be involved at the kind of VC stage? Who needs to be involved at the kind of scaling phase, kind of building S curves of technology adoption for different sectors in specific regions, and really getting down to the level of let's just get everyone in a room and figure out how do we make this finance happen. And what is it that is a policy signal issue? What is it as a corporate off-taker issue? What is it like an early stage or a late stage financing issue? And just building those connections and a better understanding from everyone of what is our role and what is someone else's role and how do we help them, because it's also like finance in the policy realm isn't they're not a benign actor, right? They
Hmm.
have
Hmm.
they have public affairs teams that do a lot of kind of policy engagement, but I would be surprised if there's like a really good group of sustainability teams that are working with their public engagement teams on specific energy transition deals and incentives. Often it's just like they're interested in financial regulation, but how do we serve our clients and support our clients with their like incentive needs that would actually help make us money? Those kind of big systems coordination gaps are really interesting, I think.
Absolutely. Well, I mean, let's hope that that this giant new budget line is on its way. And I think I could probably already sense the kind of excitement from at least a number of people I know from JFI who are on this call to hear the different kind of components of this kind of dream alignment being laid out so clearly. So we're now 10 minutes before close, and we've got a really robust list of questions here in the Q&A. I'm excited to pose as many of these as we can. And the one where I'd like to start actually is from Neil Considine at Carbon Tracker, who asks if you could talk about the asset class mix for transition finance, particularly scaling from the 2 trillion to 4 trillion a year, with a focus on these hard to abate sectors. And he shares the sense that balance sheet constraints will increasingly require that more of the funding for this back half of the 4 trillion be in the form of equity rather than debt, and asks if you agree and are worried that it will be structurally harder to secure.
Yeah, it's a great question. Thank you. I think it is just going to be a mix. I think it depends on what part of the system we're talking about. I think there is a lot of um, just corporate debt that is needed, and this is one of the challenges of having too strict a definition on transition finance for kind of labeled debt. Is that actually what we really need is more general corporate purpose that is going to corporates that have a really strong transition plan. And so that's where the assessment and the planning pieces of the nexus kind of all fit are going to be really important, because that is kind of traditionally how a kind of incumbent companies want to kind of access finance at scale, long-term kind of patient finance that they can actually do big stuff with. But for some of the harder stuff and some of the newer stuff, absolutely we're going to need equity. And this is a space where there just is no good guidance yet on what transition equity looks like. There are a couple of funds that have been explored, but actually it's a much smaller part of the conversation and is really needed. both in kind of the early stage private equity, but also public equity. There are whole markets that need to shift. And so we need to be thinking about, how do we do that? And there's some really interesting work going on in the kind of sustainable stock exchange space and thinking about, are there transition exchanges that could be set up? Excuse me, or kind of transition planning expectations on kind of new listings in sustainable stock exchanges.
No, absolutely. That's really helpful. And I should say, I mean, we at JFI are in total agreement about the centrality of this equity piece, as well as its difficulty. And this is, precisely actually one of the key questions that we've been thinking together with the Secretariat of the V20, this group of climate vulnerable countries around. It's certainly a perception on the part of, finance ministries across these countries that is one of the critical missing pieces. Anything that, helps to push the envelope on that count is, I think, going to be very, very well received. Well, so, a number of great questions here. I wonder if maybe we could take one from Jay, our Chief Research Officer at JFI, who asks for your thoughts on materiality, which is often cast as kind of an insider debate, but that seems to be increasingly spilling over recently into public forums, showing up in conversations about disclosures, regulatory authority, shareholder activism, and Jay's sense is that a narrow reading of materiality could seriously hamstring transition efforts, especially if these are kind of court-imposed narrow readings instead of kind of agency interpretations, which could be easier to reverse. And he asks how we should think about this question.
Yeah, I think there's a lot of talk and there's a lot of really nerdy talk within the climate community around materiality. And I think from the finance perspective, it is much simpler. It's like, does this really matter for does transition risk really matter for a company's ability to make money and survive over the long term? Is this like a business driver or is this a business risk? And if it's a business driver or risk, then finance cares about it. And if it isn't, they don't care. And so I think if we think about kind of this as being financial materiality, it is really critical. When we get into double materiality questions, certainly for the non-impact space, it is much more of a distraction or a box ticking exercise than it is actually driving decision making at the financial institution level. It certainly has value and has like a transparency value to it as we're mission driven organizations caring about where returns go and how returns are built so that we can create a long-term system that both delivers kind of economic return and climate outcomes. But for a bank or a financial decision maker day to day, it's much less important, I think. They care about, is this impacting my risk? Is this impacting my return? And if yes, I care about it. So materiality, first order materiality absolutely matters.
Excellent. Well, I appreciate that somewhat spicy take, and actually just couldn't agree more completely. Well, so we've got a question now from Victoria Morta, who asks about sectors like agriculture, which face a significant financing gap, and where much of the need is concentrated in emerging economies where capital flows are very limited. So what do you see as the main barriers preventing financing from reaching these markets, and which approaches or mechanisms have proven most effective in overcoming these challenges? And then thinking specifically about businesses in these regions, should evaluation criteria adapt to the local context and constraints, or do the standards need to remain kind of consistent globally because fundamentally this transition is a global project?
Yeah, it's a great question. We're certainly advocating for the corporate transition assessment piece to really be that granular, like but country specific. Getting those pathways is one of the challenges, and also just building capacity in those places. In emerging markets in particular, there's a huge amount of kind of resource burden that's being increased by just the level of kind of standards and inputting excuse me, importing kind of Western reporting standards into emerging market context is just creating like a reporting burden in both in developed and developing markets. And so it is just like it's a capacity issue, it's a resource issue, it's a training issue, to make sure that people have access to the latest kind of guidance, to the latest tools, technologies. And I also just think that there's a fundamental misunderstanding of risk, and a mismatch of risk when it comes to developed versus developing markets. And actually, a lot of the financing challenges that large private finance institutions in particular face when investing in emerging markets is just the risk perception, making it harder to get that risk return kind of profile to match up. And actually, I think we just need to do a lot more education as to the kind of physical risks and the transition risks if this doesn't happen, and that kind of understanding of where the risk really lies. So getting risk perception and risk reality to match up, I think would help. And in terms of solutions for that, I think there's a lot more to be done in blended finance, and particularly kind of how do we leverage what is the good work that public financial institutions are already doing in emerging markets and leverage that to de-risk private finance. That is much harder than it sounds, and there's a lot of work going on, but that just needs to be kind of really accelerated in my view, because I think otherwise we're going to struggle against the kind of incumbent thinking within the private finance world.
Well, from your lips to God's ears, that's what I have to say to that. So, I mean, we're right at the hour. There are two more questions that I would love to pull out of the Q&A. If you have an additional 5 minutes, maybe we can do
Yeah,
that.
sure.
Or okay, and of course, those who need to drop, please do. But thank you, Lizzie, for indulging these last couple questions. So I wanted to pose one from Travis Knoll, who asks how we combat investment bias in markets where capital markets may actually be quite mature, but North Atlantic investors could still consider them problematic. And I think, this aligns with, a lot of these misperceptions of risk that you were just talking about a second ago.
Yeah.
How do multilateral development banks and development finance institutions, how can we push them to be less risk averse and to allow more private capital to move in?
Yeah, so this comes back to what I was saying before on the partnerships thing. I think we just need much better partnerships and knowledge sharing, data sharing between the public and private, excuse me, markets. I think data would certainly help, and also just case studies of deals that have worked, because this is still like a fairly new area, and we just don't have good data, good kind of past experiences to build on. And so we just need to get deals started, and then more deals will come. It will be kind of this what we hope will be a kind of a self-fulfilling circle of transition finance if we can get the first kind of few deals going. So we call it first of a kind deal, and then that leads to second of a kind deal, and then from there we can spiral in a positive sense. But I also think that the multilateral development banks building their own tools and guidance can be really helpful. So we're actually working with a multilateral development bank at the moment, building out their transition finance framework. And if this group can create really clear guidance on how do you access transition finance, what are the expectations on corporate transition planning and kind of project level transition plans that will unlock transition finance from this bank, in partnership, and pull in some of the private finance community to that, set those standards that are going to work for emerging markets. I think that's a really great opportunity to reach scale.
Yeah, and I think actually the point about case studies of successful deals really is critical, or at least feels like it could be a major advance. It's actually just some colleagues and I were just meeting with the the director of the new blended finance lab at LSE, Harold
Yeah.
Walkate. And apparently one of their projects is going to be to develop a series of kind of HBS-style case studies for business schools of blended operations that are kind of worthy of that degree of scrutiny. And I mean, to my mind, that sounds amazing because they did a kind of review of what's out there, and apparently there's virtually nothing at this moment.
There's really not. I mean, we have a couple of case studies on our transition finance resource hub that I think, Paul, you've just shared in the chat. So thank you for that. But they're mostly in developed markets and developed market situations. So yeah, definitely welcome anyone that's got experience of doing these deals. Share those deals because then that can help build understanding and can help scale this market.
Absolutely. Well, thank you for drawing attention also to the chat, where, as you noted, I did drop a number of links to resources from RMI that those in the discussion today may enjoy taking a look at. Well, so just to close things out now with a final question, and I'm sorry we weren't able to get to all of them, but fortunately we have gotten to most, from Mikhail at JFI, who asks that banks have come up as examples of institutions that are really influential in this transition finance space. But what about the role of non-bank public asset owners like pension funds, for instance? What is their role and has it been changing?
It's a great question. Actually it was the investors, the institutional investors, the asset owners like pension funds really were the ones that were the first movers on climate change. They moved kind of in the early millennium to actually take climate change into account in their kind of strategic investment, strategic asset allocation portfolios and kind of providing mandates to their asset managers that this is something that they should take into account. And that's because they have much longer term kind of investment profiles and longer term risk profiles. So they can do some of the harder stuff. And so that's where I think we really need the asset owners to be more engaged. Because a lot of transition is just going to take time. We can't build green steel plants in 2 days. We can put solar panels up and we can build a wind farm pretty quickly. But kind of designing SAF plants, for example, sustainable aviation plants, takes time. The permitting is new, the builds are new, kind of creating the infrastructure around them all is new. And so this is where kind of patient capital, so what we refer to as kind of the pension funds and the sovereign wealth funds of the world, that's where we really need them to lean into the harder stuff, the things that aren't going to make returns tomorrow or next month or next quarter, but over time are really necessary. And so I'd really like to see them engage more in this debate. It has tended to be a bank-led discussion, at least that I've been aware of. But I think there are some pension funds that are interested and active. But again, we just need people to be more vocal about the kind of wins in this space because there's a lot of discussion of the barriers. But actually, there are good things happening, and we just need to build on those, I think.
Well, what a beautiful note for us to wind down our conversation on. Thank you, Lizzie, for this discussion. It's really been spectacularly informative for me, and also a basis for some perhaps growing optimism. Can you remind me what was the great phrase you used, the adjective plus optimism that I thought was just perfect?
Yes, applied hope.
Applied hope. That's right. Yes, applied hope. I feel like I'm living with a larger dose of applied hope than I've gotten in a very long time. Lots to chew on, and so much to continue to digest and to reflect on. So thank you, Lizzie, for this conversation, and thanks, of course, to Molly Dekchar at Jane Family Institute, our editorial director, who is organizing this series and who facilitated all of the logistics around today's session. Thank you also to Hannah from RMI, who I know has been really instrumental on the RMI side to facilitating this. And thanks to everyone who joined us, especially those who are still here at the very end. Yeah, it's been a tremendous pleasure. And I know, Lizzie, you're open to hearing directly from anyone here on the call. Email address in the chat, certainly true for us at JFI as well. And really excited to have many of you back for our next conversation in this Expert Hour series, and Lizzie to be continuing our dialogue as well.
Thank you so much, and thanks for the opportunity. It's been great. Really enjoyed it. Thanks, Paul.